Hello and good evening, everybody. Hi, Geoff. How are you doing?
Good. Can you hear me all right?
Yes, we can hear
Yep.
you.
Awesome.
All right, guys, if you can hear us, maybe you can just type yes in the comment section so that you're able to hear us and also see us live right now. Anyone, can you just mention yes in the comment?
Yep.
Okay, we'll try to get some response first.
All right. Yeah.
Okay, thank you, Afifuddin. Okay, looks like we are set to go. How are you doing? Have you had your dinner, Geoff?
No, actually,
Not yet.
well, taken to spicy food since moving here 12 years ago, and I thought, and it's pretty spicy tonight, so I thought better wait till after I finish talking, otherwise might struggle talking. Sometimes, I'm not that natural good spicy food eater, but yeah, long end of the story is not yet later. How about you?
Right. So we know what you're going to eat tonight, right?
Yeah, yeah.
All right, looks like we're all set to go. Welcome everybody tonight on tonight's session in Singapore. Tuesday, we have What's Hot in Singapore, and we're going to continue to have this on a monthly basis. So please do follow us on our Facebook and also follow us on our SGX online campus so that you get notification when we are online. And today we are privileged and honored to have our guest here today, Geoff Howie, who is from SGX. He's the market strategist from SGX, right? And whenever I go to a conference or even an international seminar, he's the one who's representing the Singapore. So he's a Singapore man right now, although he's been there for 12 years. So he's probably more Singaporean than Australian. Can I say so?
Yeah.
So Geoff, in the industry, he needs no introduction. But for you guys, I mean, he has been in the industry for more than 20 years, with a major in economics. So he's very familiar with the Singapore market, being there for quite a long time. But he's also quite familiar with the Asian and global markets as well. So again, if you have anything to ask about Singapore, ask the Singapore man over here. We have Geoff, who will be able to answer your questions. So today, we're going to talk about what's hot in Singapore. So Geoff is going to share with us, what's the trend right now in Singapore and what's happening in Singapore, so that you are able to make maybe a well-informed investment decision, because he's the man on the ground. So you'll be able to ask questions. So if you have questions at any point of time, please do just type those questions in. Myself and Alvin, we do have some questions for him, but we want those questions to come from you guys. So just type in those questions, and then he'll be able to answer us. Geoff is going to do a short presentation before we'll take a look at your answers, right? So just keep typing those questions in so that he'll be able to answer whenever after he finishes his presentation. All right. So let me just go through a little bit of disclaimer over here. Before we proceed, whatever that is being shared here today is for educational purposes only. It's not intended as any investment advice. If you do need an investment advice, please do look for a licensed professional investment advisor. All right. So without further ado, I'm gonna pass this to Geoff. Geoff, so what's hot in Singapore right now? Oh, hold on, I can't hear you.
Yeah, we can't hear you, Geoff.
Are you on mute?
Okay. Have you got my slides ready to?
Yes, it's
up?
on the screen right now. Yes.
Okay. So we're on, because I've got disclaimer. What I see is the disclaimer. Okay. Perfect. Okay. Yeah. So as we said, my name is Geoff Howie, and I guess I intend to provide an overview of the current drivers of our stock market over the next 30, 40 minutes or so before we have a question and answer session. And just to reiterate that these presentations that we provide here in Singapore, they're designed to be purely informative. Recent observations are on the moves in the stock market, and it in no way is providing investment advice. So it effectively means we're covering general commentary of historical performances that, of course, are not indicative of future performances. So if we can go to the next slide, please, Alvin and Bernie. Yeah, perfect. Okay. So I've got a chart here. The STI is the blue line. The yellow gold line is the FTSE ASEAN All Share Index, and the green bars are performances of global benchmarks in the first 7 months of this year. So the STI actually gained in July by 1%, and it brought its total return in the first 7 months of this year to 13%. And that means it effectively ranks among the top 3 performing APAC benchmarks for the past 7 months, which include the TAIEX and the Nifty. So the STI is our benchmark here. It represents around 60% of our total market capitalization, and it has companies in it that that they span as long as 200 years in the making. And then you have companies, or REITs, I should say, that are, basically being developed only in this part of only in the 21st century. So we've got a lot of diversification in there. In terms of revenue, half of the revenue that's associated with the index, when you weigh all the companies up according to their weight in the index, and then you put the geographical revenues that they report in their annual reports into those weights, 50% of the STI income or revenue is reported from outside Singapore, majority across Asia Pacific, excluding Singapore. So that's just a breakdown of the index. And the index over the past 5 years, it has been directionally correlated with the FTSE ASEAN All Share Index, as you can see on the right there, that gold dotted line. That index itself has only generated a 2% total return in the first 7 months of this year, and Singapore stocks make up 25% or so of that index. But you can see that generally the indexes are quite correlated, and it did have a higher start to the year. It basically had a stronger move at the back end of last year, and obviously a higher base than what we saw in Singapore. From our current levels, which when I took this in the mid-afternoon, it was around 31, 35, the STI, but I think it closed up a little bit higher than that. But from the current levels, it would have to gain another 5% to be at that pre-COVID-19 high, which was 32.80 back in January of 2020. To reach its May 2018 high of 36.40, it would have to rally another 15 to 16% thereabouts. And for the STI to return back to that 30 October low that it formed, 8 months ago or so, 9 months ago, it would have to decline more than 20% to around 25% to fall down to that low. So while the STI itself in the first 7 months of the year generated that 13% gain, some of the more interesting things I'd like to share with you is the difference or the different type of stocks we have listed, the very wide variety of stocks that we have listed, because there was a 60% differential between the best performing STI stock over those 7 months and the least performing STI stock over those 7 months. Okay, and that really does help to exemplify somewhat the, the diversity of businesses that are represented in the STI. So what we've had here, we've had resilient global trade and demand for container shipping across the world see that a China shipbuilder was actually the strongest of our STI constituents, generating very close to a 50% gain over those 7 months. The stock was recipient to net institutional and prop inflows in the first quarter and the second quarter combined, and those total inflows, net institutional inflows, basically led the STI constituent, this Yangtze Jiang shipbuilding company, to these higher levels. In that first half of this year as well, this business secured its largest order wins based on total contract value in the group's history, and the group's history dates back to the 1950s. And at the same time, this resilient global trade has seen shipping organisation, the BIMCO Association, highlight that container ship contracting has seen a record-breaking start to the year. So we're seeing, as you would envisage, across the world, we've had this resilient industrial-related sectors very much outpace the business and commercial activities of the consumer-led sectors. So that has been a key role in the ability for supply chains to still operate, for businesses and companies to still trade with each other across the world. And as we said, this demand for container ship has really been the big driver behind our best performing STI stock, a China-based shipbuilder. But at the same time, the STI's least performing constituent in the year to date, it focuses on property development and hotel operations. So, with hotel operations making up 50% of its revenue in the pre-COVID FY19, that the company has had to, like it's noted in May, City Developments noted in May that restrictions on international travel was still largely in place, as we know, and that resurgence of COVID-19 cases that we've seen here, it has led to temporary lockdown regimes or heightened measures, I should say, which has impacted the hotel operation recovery. So I guess it's little surprise to you when you understand how the world works these days, that a company with 50% of its revenue coming from hotel operations pre-COVID-19 is our least performer, and then on the top performer is a company that is basically doing well on the back of resilient global trade. But overall, I think what's important to say is that the STI's performance, it's really just come down to the simple fact that banks make up the biggest sector of the STI. They account for 40% of the STI, and at the same time, this sector was the strongest sector across the globe in the first quarter of this year and held its gains in the second quarter. And that sector is, of course, the banks. The FTSE ST Banks Index is 90% correlated with the STI over the past 3 years. So if we go to the next slide, we can just look at this story on the global banks. Bank stocks, as I said, they were amongst the strongest of all the industries in the global stock market in the first half of this year. They outpaced global benchmarks, and along with what we'd say the iron and steel, the semiconductor, the oil and gas, upstream and service industries, the banks were their top ranking among these top ranking sectors. And global banks in particular have been supported by resilient global investing, which is one of the main objectives of this extraordinary monetary policy that we've seen as well. So that's that extraordinary expansionary monetary policy across the world. It supported stocks and businesses of all shapes and sizes, but particularly those stocks that facilitate banking and facilitate investing activity. And another driver of the outperformance, the strong outperformance in the first 6 months of this year, and this is very relevant to the second half of this year, is the movements of the US yield curve, the difference between the yields of the US 2-year Treasury notes and the 10-year Treasury notes. So as we know, the steeper yield is good for the banks, and the 2-10 US yield curve, it averaged 130 basis points in the first half of this year, which was quite steep because it compared to a flatter 60 basis points in the second half of 2020. So it's steepened considerably. And banks, as we know, as we said, why it's good for banks is because banks generally known to borrow short. They borrow short, so better to have the lower rates on the short end, but they lend on the long side, on the long end of the curve, and hence it's better to have the higher rates on the long end of the curve. So that 2 to 10 US yield curve, it averaged something like what was interesting, like I said, it was 130 basis points in the first half of this year, but in July, just in the month just gone, it averaged 109 basis points, which is quite a lot flatter. And what we saw is the Bloomberg World Banks Index and the big global banks, they actually declined in July by 2.2%. But in July, the Singapore trio of DBS, OCBC, and UOB, they actually averaged a reciprocal. They averaged 2.2% gains. And the bulk of those 2.2% gains was attributed to the MAS lifting the dividend restrictions on those three stocks that they introduced last year. And theoretically, if the banks were to distribute their FY19 distributions in FY21, their respective yields, based on today's closing prices, would be 4.1% for DBS, it would be 4.4% for OCBC, and it would be 5.0% for UOB. Yes, I mean, it's similar, pretty similar to Malaysia in that I know because I broke in Hong Kong many years ago, and back then the regional banking stocks that were known to have the good dividend yields were, of course, Malaysia and Singapore. So that's pretty important because that's only just happened at the end of last week. And you might recall the trio had to trim its FY20. They had to trim their FY20 dividends to 60% of the FY19 levels to bolster their ability to serve credit needs and absorb potential shocks if they came, which they didn't. DBS, OCBC and UOB also remain among the top 10 constituents of the FTSE developed APAC ex-Japan Sustainable Yield Index. And the three banks have now consistently reported more than $5 billion in combined quarterly net interest income for the past 3 years. And that in terms of their plans or their objectives for the year ahead, it's really digitalizations there, broadening wealth management services, and this continued focus on supply chains and growth markets. And they to report tomorrow their first half numbers. Tomorrow you'll have OCBC and UOB reporting, and then on Thursday DBS will actually report its first half numbers. Now the Singapore banks also, I should say, they average a 16% premium to their book value at the moment. So their PBs, they price to books, really remain well off that 40% premium that we saw back in April, May 2018. And we all asked, what's it going to take for the banks to get back there? Well, for those PBs to be around the 1.4 level, things to look out for is what we saw in 2018 as well. You might recall back in 2017, Singapore was amongst the world's strongest advanced economies that year. And it was also home to one of the world's strongest performing stock markets that year. So there's a lot to take into consideration, which actually drove that 40% premium to book value at those highs on average for the banks back in April, May 2018. And for the moment, they're at a 16% premium. And the movements in the Singapore banks have been very highly aligned to the global banks. And that's what I'm trying to show in this left chart. The blue bar represents the average of the Singapore trio. And then you can see the top quartile of global banks' median moves in the orange. And you can see just how closely correlated they are across the world. Okay. I should also say that, as I said, the moves in the yield curve, they've seen a lot of rotations into and out of the global banks and vice versa. The dot plot surprise that we saw back in the 16 June FOMC meeting, it saw the 2 to 10-year yield curve flatten from 135 basis points to 120 basis points just in the space of 2 weeks or so, from the 16 June to the 29th of June. And then we also had these added hawkish comments from some Fed members. So in that week, the EPFR Global actually saw the largest outflow for financial stocks since March 2020. So the directional correlation, I guess, of the yield curve to the global banks and the impact on recent sector rotations, we try to show this in this, just trying to depict some of this in this in these right side charts. You can see in the top one, you've got the Bloomberg World Bank Index rising higher, represented by the blue line, and then you can see how the other line, the gold line, represents the actual fall in the yield curve, and how the fall in the yield curve has really seen the World Bank Index come off as well. But since the end of May, that US yield curve, it has flattened from 145 basis points to 100 basis points, mostly on the decline in the 10-year yield. And that's, as we said, so that's coincided with this top blue line, the World Bank Index declining 5% since the end of May. But at the same time, the bottom chart shows you that the decline in the 10-year yield has seen the FTSE EPRA Nareit Global REIT Index gain 8%. So the decline in the 10-year yields has benefited the REIT sector, and you've seen rotation out of the banks into the REITs. Performances would suggest that the decline in the 10-year yields has seen that rotation. But what's happened is presently the US 10-year yields are at 1.2%. And what that's done is increase the yield premium of the FTSE EPRA Nareit Developed Index to the US 10-year yields from around 150 basis points back in mid-May to 200 basis points now. So that interest rate premium on the yield premium on the REITs to the actual 10-year yields has jumped up by as much of a quarter. And that comparatively higher yield compared to the 10-year yields, the comparative higher yield of the REITs compared to the 10-year yields has seen the REITs basically actually pick up quite a bit over the last 6 weeks or so. So banks, as we said, banks started hot. They lost some of that heat with the moves in the yield curve. And then what we've seen is rotation with the REITs because it's the long end of the yield curve that's actually come down. If we could go to the next slide just to quickly kind of, I should try and speed it up a bit. So what I've got here is to just show you some year-to-date and some recent flows. What I've done is taken the 100 most traded stocks on our exchange. Okay, so that 100 stocks, it represents around 72% of the total market cap of all the stocks listed on the exchange. In terms of those 100 stocks, you know we're a REIT hub. 27 of those stocks actually represent REITs. Okay. And REIT sector, that actually did not too bad, up 3% in July, bringing its year-to-date average returns of those 27 REITs that are among our top 100 stocks to 13%. Okay, that's how we can interpret these charts. The energy sector up the top there really led the 100 stocks in July. Rex International Holding and RH Petrogas gained 15% and 6% respectively. Since Rex International listed in July 2013, the group's achieved, I think, 4 offshore discoveries, 1 in Oman and 3 in Norway. And the group also offers its Rex virtual drill screening services as well. But back in March, Rex detailed that oil and gas drivers for the year, they were including the impacts from the pandemic. Oil firms were planning to pivot away from fossil fuels to renewables. You had OPEC production levels that were being really focused on with Saudi Arabia and so forth, taking the cuts. And then you had this robust oil demand both in China and India, and this continued lack of substitutes to power various transportation modes as the key drivers. RH Petrogas also noted in May that key drivers included those collective efforts of the OPEC members towards providing stability in the oil markets and the stabilizing labor market in the US and the falling crude inventories in the US as well. But after energy, which as you can see, there's those 2 stocks have really led the market. The technology sector was the next performing sector across the 100 stocks, with I think Nanofilm Technologies International leading the 6 stocks with a 13% move in July. And the average sector performance, I guess, of the most 100 traded stocks for the first 7 months in that second table. So you've got the on the far left, you've got July. Then on the next, you've got the year to date. But what I've got to mention is those average performances, they can be skewed a lot. Like the oil and gas, you can see that very strong green line there. That is skewed because you've got RH Petrogas gaining 600% over those 7 months. For the industrial sector, that was up 50% year to date. That was skewed by CFM gaining 600% as well. And then like The place holdings also led the consumer cyclical sector with a 252% return. So these are only average returns, and they can be skewed by one stock. So just a caveat there. But I guess together, the 100 most traded stocks over the 7 months, they did book net institutional outflow of $549 million. It was $549 million of net institutional outflow in July, which brought the net institutional outflow for the whole 7 months to around $780 million of outflow. Now, what's interesting is STI stocks typically dominate the inflows and the outflows, and that's obvious based on the comparative size of the STI stocks in the terms of their market capitalization. However, in July, of the 30 stocks of the 100 that saw the highest net institutional inflows, only 6 were STI stocks. For net institutional outflows, 21 of the 30 stocks that booked the most institutional outflows, net institutional outflows in July, were actually STI stocks. But like the July performances in the chart, energy led the net institutional inflows proportionate to market value in July, while telecommunications led the net institutional outflows proportionate to market value in July. Okay, so what we saw is the net institutional flows very much followed the performances, which is expected as well. So you can see telecommunications in the bottom right led the outflows proportionate to market cap, and then they've also led the underperformance as well. They led the laggards, so to speak. I guess what was interesting too, Rex International and RH Petrogas both booked 6.8 million in combined net institutional inflow in July, and that brought their, and how we're working it out, I guess, is they've got around $7 million of combined net institutional inflow during July. You take their proportion, you take their combined market value of 400 million, you divide the 7 million by the 400 million, and that gives you the 1.7% of that you can see in this chart. July sector net insti flow proportionate to sector market cap, energy and oil and gas, it's at 1.7%. What that 1.7% means is just that you had $7 million of combined inflow divided by the combined market cap of $400 million. So for July, Capital Land actually saw the highest net institutional inflows in July. It saw $83 million of net institutional inflows. The company has been very busy in its campaign ahead of the EGM scheduled next Tuesday to convert Capital Land, restructure Capital Land into Capital Land Investments. The group has pretty much attributed its 20% gain to 25% gain over the first 7 months of this year to this significant restructure, which is going to sharpen its focus into this more business efficient asset light entity Capital Land Investment. So the meeting is scheduled for next Tuesday, the 10th of August, and the expected date for the delisting of Capital Land and the listing of Capital Land Investment shares is on or around the 17th of September. The company is also poised to be a leading real estate investment manager once this transition, if approved, goes through. It will be among the top 3 of the world's listed global real estate managers. So you've got Brookfield Asset Management, you've got Blackstone Group there, and Capital Land Investment will be the 3rd in terms of the largest real estate investment manager listings. Securitization of real estate assets across the globe, it has really intensified over recent years to the point that real estate now, in terms of the stock market's got so important that you've now got the big index categorizers that have, or the index providers that classify stocks now as real estate sector, whereas before they were a subsector of the financials. So they now have their own sectors and industries, the real estate business rather than being a subset of financials anymore. And one key reason is to unlock value. And what they mean by unlock value is that APAC listed real estate managers do trade on average at valuation multiples that are higher than the real estate developers. So at the time they announced this, real estate managers across APAC were trading then, and I think currently a bit higher, but they were trading then, the real estate managers, at a 10% discount to their book value. Whereas if you looked at the developers, the median discount for the real estate developers across APAC was actually 25%. So they do trade at premiums, these real estate managers, and hence, in a way, this company is looking to work with this to unlock value for their investors. So if we go to the next slide, just to kind of really reiterate or show a different way just how different these sectors are, because we've got the green bars and the red bars here, but I've got a heat map in the next one that really puts it all together. So we take all the stocks that are listed on the stock exchange, and we take the returns every month of the stocks that make up these sectors, but we do weigh the returns of the sectors to their market cap. So if one stock has $1 billion market cap, their performance won't have as much impact on the sector. It'll have 10 times less the impact on the sector than a stock that has $10 billion of market cap instead of $1 billion of market cap. But they just wanted to show that the monthly performances that really are represented by the stock market, that there's, with all this great deal of liquidity in the market, there's been a lot of rotations, so to speak, and on the back of those rotations, we've seen on average a 17% performance differential between the least performing sector and the best performing sector over the past 18 months, with the median gain of the top performing sector since Feb 2020 at 13% and a median decline of 4% for the least performing sector. So as we can look in the top far right, you can see commodity gains have had these sector impacts, materials and energy, through the materials and the energy sectors that are being, right up there around the top. Rotations, I guess we did see them in healthcare. You can go back further and you can kind of see that healthcare was among the best performing sectors in 2020. And materials was up there as well in 2020 as a good performer. Tech reg remain, well, I mean, I just should say on the materials front and the resources stocks, while tech regulation really remains in focus at the moment, particularly in China. In recent, I guess, in recent times, we've seen all, especially in July. In July, we see all the major sectors in China were in the red in July, and this really led the FTSE China A50 index down. So China market was down 13% in July. All major sectors were in the red in July, except for one. That was resources and materials. And that has been the strongest sector in China in the year to date. And interest in that sector has extended to the China-based stocks here listed in Singapore. Zhejiang Chemical is the most traded catalyst stock that we have on SGX. And over the past 7 months, it's also ranked as a top 40 stock by turnover. It trades around 9 million Singapore dollars a day. And while the stock only generated a 6% return over the last 7 months, it did gain almost 400% in 2020. The company reported its net profit in the first, I think it was for the first quarter of this year, was 30 times its net profit year on year. Its main product, DMF, has a diversified range of applications, which include being a feedstock for polyurethane and pharmaceutical goods, as well as being an industrial solvent. So this commodity impact on the stock sector performances, you can see it in this heat map with these materials and energy really dominating the far top right, and that has really been on the back of commodity prices really largely driven by these COVID-led constrained supplies. Other drivers include industrial sectors recovering faster than consumer sectors that we touched on before, agricultural stockpiling, the OPEC supply management, of course, and in addition, a key driver on that really kind of started this whole restructural pricing of the commodity markets is that the average let's say the average daily close of the US dollar at 92 over the US dollar index at 92.0 over the past 12 months, it was 6% lower than the average daily close for the preceding 12 months. So the decline in the US dollar was a big driver because the US dollar provides the benchmark for pricing for most global commodity markets, and it therefore has this direct impact on the price of commodities. So if the US dollar weakens by 8% to the China renminbi, US price commodities become more affordable in renminbi terms. And that has buoyed a lot of demand for the US price commodities, which in turn has driven the commodity prices higher. Look, as detailed in the sensitivity analysis by our energy stocks, Rex International and Fortress, the weakening of the US dollar can increase profit for commodity explorers, while the strengthening of the US dollar has the opposite effect. So Singapore's 5 most traded upstream resource explorers, they've all gained in the year to date. They've actually averaged triple-digit returns in the 2021 year to date. So we go to the next slide and just quickly move on to manufacturing stocks. So this is interesting too because there's a lot of connection between the Singapore economy and the Singapore stock market here. Singapore's 20 most traded manufacturing related stocks, they span 5 key sectors: technology, consumer non-cyclicals, industrials, healthcare, and material and resources. And the wide span of these industries, I guess from semiconductors to consumer electronics, agricultural producers, shipbuilders, personal protection equipment and the rubber gloves, to chemical manufacturing inputs such as Zhejiang Chemical, it's quite a diverse field, and the very much like our manufacturing sector as well. So our 20 most traded manufacturing stocks, they actually represent 20% of our day-to-day turnover on the exchange, and that's very much like the manufacturing sector in Singapore also makes up 20% of our GDP. And all these 20 stocks have international revenue streams, companies based in Singapore, China, Malaysia, and Thailand. Now, in terms of performance, Singapore's manufacturing sector, it expanded 15% year on year in the first half of this year, with a month-on-month decline in June of 3%, which was the largest month-on-month decline we've seen since October. So that wasn't the good news, but the good news was the 15% year-on-year jump. But similarly, these 20 stocks, they averaged a 16% gain in the first half of this year, and then they also saw a 0.3% decline in July. So a little bit of momentum had come off on a month-on-month basis. But similarly too, the semiconductor cluster in our manufacturing segment, it expanded 26% year-on-year, really led. And then we also have these AM Holdings, UMS Holdings, and Franken Group, the semiconductor relevant stocks listed on SGX. They also led. They averaged 33% total returns over the same period. And since the end of the June, the trio have averaged 6% gains, which includes a dividend distribution by UMS Holdings. So there are a lot of synergies there in terms of our economic numbers, as well as, of course, the stock performances. Engineering Solution ISDN Holdings was the strongest of the 20 stocks, and it did note in its AGM in some Q&A this year that it had been seeing the benefit of China's broad ramp in semiconductor capital expenditure, and that was through 3 ways. First, there's geopolitical industrial competition and the global trade tensions. They were diverting trade, supply chains, and capital to our part of the world, in Southeast Asia. They also noted that the trade tensions were accelerating China's industrial push towards Industry 4 automation, and it was seeking to avoid competing with Southeast Asia on cost, and instead actually pushing up its position in the value chain in the advanced industries, which when you push up into the value chain, it basically moves the curve out and benefits all the supply chain players. And China's technology ecosystem, it mentioned as well, was looking to reduce its reliance on US and European technology in favor of Asia-centric suppliers. So we had our we are seeing in manufacturing a lot of transformation. The IMF Singapore Country Report came out a few weeks ago, and it noted that Singapore had made significant strides in the digitalization of production through industrial robots. So industrial robots are really those higher end digitalization products that are used really for automation in the manufacturing sector. And they have increased rapidly here in Singapore over the past decade. They said we had, basically 45 operating robots per 1,000 employees in 2008, which has grown from just one operating robot per 1,000 employees back in 2008. So sorry, what we had 45 robots per 1,000 people in 2018, and then one operating robot per 1,000 people in 2008, employees in 2008, which makes Singapore one of the top users of industrial robots in the world, with, of course, most of the industrial robots used in our semiconductor subsector. And I guess as reported last night too, we had our PMI, PMI registered 13 consecutive months of expansion for the overall manufacturing sector, and also a 0.2 point increase to 51.0. And then obviously beyond headline growth, what we want to also see is what we need to see in our manufacturing recovery is more broader and less uneven growth across the various sub-industries and the sub-clusters going forward. Okay, so at the moment, as we see in the stock market, the semiconductor, consumer electronics have really led, but then transportation engineering still has a ways to go with basically international travel and the maritime business still needing to recover more stronger. But what we should do, we should quickly go into the final slide, okay, and just look at some of these key market drivers, which will probably work into Q&A. But look, the key drivers for our market, as hopefully I've been able to convey, it's a very international driven market, stock market. What we've got from our banks sector, international banks, to the international manufacturing segments, to basically the REITs and so forth. But look, the race to vaccine the world still really continues. I think as of yesterday, we've had 4.2 billion vaccines administered globally. But the current new confirmed global COVID-19 cases, they still remain globally around that 600,000 mark per day. And while it's off the April high of 900,000 cases per day, we've still got that the global mortality rate is still in the vicinity of 6,000 to 8,000 people per day. It has not been able to break below 6,000 people per day all year. And the world is probably in the next 24 to 48 hours is about to report the 200 millionth case of COVID-19. It's about to reach that threshold. As of yesterday for the region, Indonesia's administered close to 70 million vaccine doses. I think Malaysia and Philippines have each administered more than 20 million vaccines. Thailand's getting close to that 20 million mark as well. But sadly, what we did see in June is that globally, we actually, across the world, we saw 90 million less vaccines administered in July than we did in June. So we did see the upward momentum of the vaccine rollout. It did actually decelerate in April, and then there was a quick knee-jerk reaction to really accelerate the campaigns to get the vaccines going again. So we might be hopefully seeing a little bit of an acceleration in global rollouts. On the liquidity front, the Fed Reserve balance sheet is now $8 trillion US. The ECB balance sheet's at 7 trillion euros. Money supply growth rate, proprietary liquidity measures that a lot of economists will pursue, they are beginning to normalize, and that makes sense with sharp declines since March, because the rate of growth of money is on a year-on-year basis starting to come in, okay? And at the same time, we're also getting more and more of these individual opinions from Fed governors and Fed members. Following not the recent FOMC in July, but the one back in mid-June, the Fed chair did make a note that that there would be more individual opinions, and make a note that the dot plots themselves are just a bunch of individual projections, not a committee forecast, not a plan. But these different expectations from FOMC committee members, the current, the future alternate members, and so forth, it does have the potential to provide more volatility in both yield curves, global banks, and global stocks by extension. And furthermore, the Fed members may seek more airtime to speak in the latter half of this year on their individual outlooks, because the Fed chair has made a commitment for the Fed to be a lot more transparent in the tapering, so they can give as much notice as far as possible. So we'll have a lot more Fed speak, so to speak, you would think, and that can have the ability, with the liquidity still pretty high in the markets, to see some quick rotations and quick moves here and there. On the inflation front, I think most focus is on the cost push inflation than the potential of demand pull, because of the excess slack in services and so forth. From a cost push effective, the thesis that inflation has been transitory, so to speak, it has been strengthened for the moves in the commodity prices, because you've got copper, which off about 10% from its May highs. Iron ore prices are off around 15% from their May highs. Soybeans off 15% as well. However, you've got sugar, crude palm oil pushing new highs. Crude oil, it does remain around those 2018 highs, October 2018 highs, thereabouts. And on the other hand, you've got global ETFs that are seen as the inflation protection ETFs, also trading near highs. So similarly, I should say, we've got two iron ore explorers and producers based in Malaysia that have come off their highs in May as well, but they're still up triple-digit percentage returns in the year to date. So commodity prices themselves are a key to understanding inflationary pressures these days. If you look at the Fed Reserve chairman's press conference last week, he mentioned inflation 35 times. He mentioned tapering about 5 times. And when he did mention inflation, he did actually talk about crude oil and the impact of commodity prices. So the commodity, as I said, the thesis that it's transitory is based on so many commodity prices not pushing through those May highs, but actually coming off a little bit. Now, if they do go back to those May highs and push through, then it will be a different thesis. So that's one thing to be wary of. But I think I want to end on a positive note, and I really do think that for the regional consumer markets, supply chains, they have been subject to very substantial restructuring over recent years, and that's been influenced, I guess, by the rise of the Asian consumer, Asians wanting to buy Asian brands, not US brands anymore, well, less US brands, I should say, or less Western brands. And then you've also got this development driving trade growth, such as technology, communication, and e-commerce. And the IMF estimates that 2/3 of the world's industrial robots are used in Asia together, so it's not just in Singapore. And the share of retail sales taking place in Asia is 1.5 times what it is in Western Europe or the United States. So hence automation, e-commerce are really playing key roles in facilitating the channeling of these countries, such as China, that have the very high household savings into more consumer-driven growth. And a more consumer-driven region would expect to see significant augmentation of service-orientated industries across Asia, and GDP to be obviously then less led by exports to the West. I think 3 key mega sectors that are typically associated with such domestic demand models, and this is coming from my economic knowledge and so forth, is that, and it's partly to do with onshore regulations and ultimate consumer focus of where we're going, but they're finance-related services, they're business-related services, and then the information and communication services. So that's one thing to really watch out for too, and it's one reason why the tech regulation is so important to China, because tech is they have booked on or banked on tech playing a very key role in that ultimate rebalancing of less savings into more consumer-driven growth. It's e-commerce which is facilitating it, and hence that's why there's so much focus on it at the moment to get it right. But I think as the economies really draw closer to normalization in this second half, we're going to see rotations continue, and interest in that short-term trading is expected to continue as the investors, especially in our market, look to these macroeconomic cues that really do have a big impact on our market.
All right, thanks, Geoff. Thank you for that. Quite a thorough presentation that you had there. I thought it's going to be a short one, but
No,
And only 4 slides, right? Only 4 slides.
yeah, only 4 slides. But look, I mean, the key point is that I guess there are many dimensions to our market. You know, lots of them, and I'm trying to kind of just trying to kind of story tell to make that, you know, just to show you how these big global markets actually do translate to movements in the local small little red dot stock market.
Right. So, guys, if you have any questions for Geoff, you just type those questions in. We probably got about 10 more minutes left. So, first come, first serve. You can ask your questions right now. But before we answer your questions, let me just make a few announcements before we continue. Yeah. So, we have actually a Facebook group where we discuss anything about Singapore. So, we have a Facebook group called ET Online Campus SGX. You just need to search for it on your Facebook. We also have a Learn and Win campaign, which is going to start at the end of this month, where there will be quizzes for you to answer, and you'll win some prizes. All right, cash prizes go to your e-wallet. All you need to do is to basically get into the group and follow that group, because the quiz will come out at any day. All right, so if you are subscribing to the group, you are able to get notification whenever the quiz comes up. So you have to do that. That's number one. And it can also appear in any of the webinars that we're going to have later on. All right. So please do join ET Online Campus so you get notifications whenever we have a live session, or whenever we have a quiz up there, or whenever we have any other information that's important for the Singapore market will be on that group itself. The next thing that you need to do to participate in this campaign as well is for you to join the SGX Invest Telegram group. All right. You just go to your Telegram. You have to basically just go to SGX Invest. Search SGX Invest in Telegram and just join. If you don't join them and if you won the quiz, you will not get those prizes. So you need to do this too, right? ET Online Campus SGX. Join the Facebook group and also search SGX and join SGX Invest on Telegram. And SGX Invest Telegram is basically run by the Singapore Stock Exchange. So you actually have a lot of information, including Geoff's some of his analysis on the market as well. He do some updates on the SGX Invest Telegram as well. All right. And the other one is, SGX also has a Facebook. So just go to Facebook and just do like and also follow them on the Facebook so that you get more information and notifications from SGX. Right. SGX Mobile. You can also download the app on SGX Mobile. You can go into Apple Google Store or even Android Google Play. Then you are able to join them to get more information on SGX. All right. Okay, we have also provided a link. You can just click on the link that is provided on the comment section. All right. That's where you can also join the ET Online Campus SGX. All right. So questions, guys. Alvin, you have any questions for Geoff?
Yeah, look, I think I'll just kind of kick it off, while some of the viewers, because we're a little bit on a 20-second delay. But, Geoff, I think one thing that a lot of Malaysian investors love or are extremely interested in, and actually I covered some of them last year, are semiconductor stocks, right?
Yeah.
and we kind of compare the two markets, and we kind of really see the kind of big differences in valuations between some of the semiconductor guys listed in Malaysia versus Singapore. So it almost makes the SGX semiconductor stocks look quite cheap, right? In a sense, you look at 10, 20, or maybe just in the 20s, right, or PEs, right? What maybe you can share a little bit about that space. Who are the key drivers? I know you mentioned Franken, who has large operations base in Malaysia, and also UMS Holdings, right? So what kind of are they mostly sort of second tier or third tier suppliers to some of the big names, or are they mobile phones? What are they?
No, I mean one's testing, contract, and handling, and that's AEM Holdings, and that actually had that's actually a company that's done really well. In fact, when you looked at performances going into this year, 2021, over the past 5 years, it was one of the world's very best performing technology stocks. Then you've got UMS Holdings, which is in semiconductors, and then Franken Group as well. You have that trio, okay? And the trio generally do follow the big global semiconductor indices. It's almost like our three banks the three banks, DBS, OCBC, and UOB, very highly correlated to global bank indices. So I would say in terms of turnover, they're not top 10 stocks by turnover every day. They're more in the top 50, around the top 50. AEM Holdings does actually trade a little bit more as like a top 30 stock. But they, as I said, these companies are, I think the turnover's increased significantly in the last few years, but it's interesting that we have these segments of the market that obviously become relevant, and then they can really see activity really drive them and their performance as well. But there's still there's probably more. We've got more stocks in there too that are semiconductor related that still have that issue that if they're not in the STI or they're not in the top 50 turnover every day, they tend to get overlooked. So I think I'm just going back to the premise of your question. That it's a great sector to follow, and obviously the Semiconductor Industry Association, the electronic cluster numbers we get here show how demand is expected to continue going forward, and how I think how our companies here tended to differentiate themselves from the big players too were that they were onto the supply chain issues early. They were onto the shortage of supply and so forth, and finding ways to really increase supply chain efficiency. That was in last year's annual reports that they were actually looking to improve their throughput efficiency before January, when we all started hearing about semiconductors needed for automobiles and there was a shortage and so forth. So again, we are in a part of the world that really needs to trade, really relies on global trade, and for that reason the companies have been able to continue to grow their business to date.
Okay, thanks for that.
But what's the valuation? I've priced the book. That the hardware stocks never, they always have that trailing valuation from the software companies and the internet companies and so forth. So price to sales tends to be a pretty popular type of metric to follow them with.
Price to sales, okay, all right.
for the technology hardware companies.
Okay. Okay. I think I'll kind of it was good insights, and I was kind of taking down some of these notes here. And let me just see. So you mentioned why do you think the Chinese shipbuilder, why
Why is he
ZJ?
young?
Wow, yeah.
Why is
Why?
that, Jack?
Yeah. Why did they do so well?
Yeah, I mean it's their order book, and look, there's different types of ships out there, right? Tankers, bulk carriers, and container ships. And at the moment, I think e-commerce growth has really changed the curve, and there's a lot of trade going back and forth. There's a lot more than usual. So the industry itself, as we said, is looking outside of the actual companies themselves and looking at the associations that a lot of these companies are with, have been saying, global trade has been incredibly resilient because it has been able to survive. It has been able to be resilient through all the containment measures that countries have really introduced. Less so on certain goods, like food shortages and so forth, perishable goods and consumer industries. But for textiles and merchandise, you've seen that it's global trade is of course expected to outweigh global growth. I mean, global growth for the world to go from a decline of 5% last year to a gain of 5% this year, we think is pretty incredible. But global trade's going to grow even more than global growth this year, global GDP growth. So resilient trade is the key reason for that. And for the trade side of it, it's the container ships that have actually been in a lot of demand.
Okay. I think there were quite a lot of graphs in there, and I think some of the viewers at home might be struggling to kind of look at them through their small screens.
So well.
No. Well, would they be able to download some of this later on?
Yeah, of course.
Are they shareable?
I'll absolutely. I'll clean them up and send them to you. But a lot of them will be. I mean, a lot of them will be in that channel, Invest channel, the SGX Invest Telegram channel.
Okay.
And there'll be links there, and you'll be able to see them a lot clearer.
Okay.
Okay.
I was just wondering if those of you who are interested, I'm not sure how many of you in the crowd are interested. Just type yes if you are, and then we'll find some way where we could drop the link on our Facebook page or something, and you guys could download some of the slides. I think one of the interesting ones were the rotational plays, right? So where you look at the green and the red. So are the ones that are in red really the ones that have come off? That means they're down. And I guess if you're a value investor, you should be looking at the reds, right? Or those red sectors.
Yeah. I mean, to an extent, but a lot of them really do depend on, like we said, like you look. Okay, we talked about the STI's best stock, and that's because the bulk of its orders are in container ships, and container trade is continuing to be really strong. But on the other side, city developments, which, as we said, it was 50% hotel ops pre-COVID. That's the STI stocks that's in the most red this year. But you've got to, I guess, just kind of do your homework on the stocks and understand what the key drivers are and so forth for the value investors. Value investors know this as well, right? You look at things such as the income, the financials, what the brokers in the street are saying, and so forth. I mean, it depends how hardcore of a value investor you are. I mean, there's the contrarians, right, as well. We used to have the FTSE ASEAN Value Index that FTSE would publish with value partners in Hong Kong, and one of the criterias for that was that I think you couldn't have majority. It was, I don't know what the percentage was, but it was something like you couldn't have majority of the street having a buy call on the stock. Otherwise, yeah.
Okay.
But there's just one thing too, in terms of just one caveat too, especially when it comes to the REITs. Over the past 12 months or so, when we put out those high yields that can attract the value investors, we typically like to, when we're highlighting those, also highlight what the price performances was, and filter those high yields, and combine them with stocks that actually generated unit price increases at the same time.
Right.
I mean, you know the story, right? A stock could
Yeah.
fall 40% in price, and it boosts the yield up by so much. So
Yeah.
Yeah, we do have a question here from the audience. We have a question from Sim. He's asking actually two questions over here. Number one, what's the ratio between institutional and retail investors on SGX, and how it compares to the rest in the region? And number two, who are the big institutions, market maker on SGX? Like in Malaysia, we have Khazanah and EPF, right?
Exactly, and we have big institutions as well. I'm not supposed to name them, but obviously they're. I mean, we don't just have big institutions; we have small as well. So market making is quite a competitive industry in Singapore. Obviously, we have the largest bulge banks in there, but you also have smaller companies as well that are playing a key role in that. The ratio of institutional and retail investors, and how it compares to the region, in terms of the institutional investment in the market, it is mostly institutional trading, but like the region, and I hope I'm answering this okay. Most of the flows into the index stocks, like your KLCI or your SDI, and then I guess your next broader level index, are institutional flows, because indexes, there's like the Malaysian market plays a very important role in the ASEAN market, which plays a very important role in the Asia market. And you have so many pension funds and massive institutions across the world that have to follow our stocks, and have to basically have a weightage in their portfolios to our market. So that basically means the majority of the daily turnover comes from institutions rather than retail investors. But then for the smaller stocks that aren't part of the indices and so forth, you'll see the retail participation really pick up. And just to make that point, index flows, index benchmarking, for institutions, those flows can really compare in size quite significantly to your balance of payments, so to speak, your actual trade flows. The physical trade flows can be on par with the index flows that can come from overseas institutions. So the ratio of institution to retail investors will always be really high for the index stocks. But for the smaller stocks that aren't part of indices, they can, especially if they can move around and they have coverage by the local market and the research providers, they can be subject to more retail flows because they don't have the automatic institutional flows. I should also note that in terms of those flows, and to validate what I'm saying, is that when the stocks generally tend to rise, you generally see more institutional inflows, institutions following the stocks up. But what we've seen in past flow reports is that you have retail generally, or plenty of examples of retail tending to be buyers in the weakness and sellers in the high prices. Okay.
Right. Okay, thank you. Hope that answers the question, Sim. Okay, we have another question here. Probably the last one for tonight. We have a question from Lily. Are investors able to short sell in Singapore, or are there any restrictions or limitations on retail investors?
Yeah, it depends at the broker level, Lily. It all depends on the broker and what the broker can provide and so forth.
All right.
I hope that presentation wasn't that bad. We're gonna
No, I guess there's just too much information to digest. Maybe next time we just focus on one or two sectors instead of.
Well, we can. I mean, that's the thing. I mean, I would love to do more of these with you. And I did kind of want to give a little bit of try and throw a lot at you tonight, because then there might be more aspects that might resonate more with your base, and we can explore, go a little bit slower, and explore certain segments in a little bit more depth, like the semiconductors album. We could easily pick that one up and go through the 5 or so companies, and especially as they're about to report their numbers as well.
Yeah, I think it's quite awesome though, because being here in Malaysia, we probably don't have a lot of news in Singapore, but there is a lot of happenings in Singapore that we should actually look at as well, like what Geoff has mentioned earlier. So there are quite exciting things, and we do hope to have Geoff once again on our session. We'll go into more in-depth and more details on a particular sector that which is currently in the trend. Right. So yes, Geoff, thank you so much for joining us tonight, Geoff.
Thanks, Geoff.
Thank you so much.
Yeah. Okay, and guys, once again, you want to get the slides and the data and information that Geoff presented earlier, please don't join the SGX Invest. I will already put in the link there. You can just click on the link to join the SGX Invest group. That's where you get a lot of information, including those information that Geoff shared today as well. All right. And make sure you also join our ET Online Campus group, so that ET Online Campus SGX, all right, so that you get updates and notifications. And when we have Geoff once again on our show, we do hope that we are able to get more from him for the Singapore markets. All right. So once again, thanks, Geoff and Alvin as well, and all of you guys who have attended as well tonight's session. Thank you so much for spending your time here. We see you again in the next session. Till then, have a good evening.
Bye.